please subscribe. Just hit the subscribe button or the notification button at the bottom of your screen. It helps us a great deal and helps me to produce these videos. So welcome to our webinar on the trend is your friend. Now, as a trader, you have probably heard the old adage, the trend is your friend. Well, I like to extend that adage a little bit farther. The trend is your friend until it isn't. Now, this is sage advice. If you always trade with the trend, you will find that statistically, you will make more pips for every trade. Trading against the trend or trying to catch a knife is very, very difficult. And when the markets do retrace slightly, it's not enough pips. Whereas if you statistically trade over and over with the trend, you will end up ahead in the long run. You will have more larger successful trades. You won't increase your good trades to bad trades. But on your good trades, if you make 30, 40, 50 pips as opposed to making 10 or 20 or 30 pips, you will end up in the long run ahead. Now, there are many ways you can determine a trend. And we can determine trends in, I believe, using the keep it simple rule, the KISS rule, and keep it simple stupid. You need to get into your head that the markets are random. Price is random. No matter what somebody tells you that you can do this and you can do that, you can apply this mathematical calculation and you can follow this strategy, use this robot, use this scanner, and you can make tons of money all the time, they're full of it. Price is random. Nobody, but nobody, can predict where price is going to be in a few minutes from now or a few hours from now. We can speculate. We can hopefully move the odds more in our favor. And we can try to predict. Now, remember also that we all have different types of trading and investments. We are looking at different time frames, and this is individual. Trends or the market movement or trend can be very short-term trends, especially if you're looking at a 5-minute chart or a 30-minute chart. Or they can be longer term trends. You can be looking at a trend, say for instance, gold has been trending up for 20 years. Okay, that's in a long term trend. But gold could have been falling in the interim term trend and could be up in a short term trend. So time frames that we're looking at dominate everything. But understanding how price is moving in the longer, the shorter, and the medium term are very, very important. Because if you said the euro was the very bottom, and you're looking at a 1-hour chart, it could be. But wouldn't you like to know that the euro is at the bottom of a short-term downtrend, but overall the euro has been trading up over the last 2 months. So you need to know that there is this up pressure, but you're going to take this down segment. Okay. But if you say the euro was trading way down over the last 6 months, which it has been, or the last year, and the medium term, it's been an uptrend. So the euro bottomed out at 106, been climbing back up to 114, but now it dropped down to 105 or 106. Those are 3 different terms in different trends in different time frames. Now, I firmly believe in my own definition of the markets, and that is that price is always random. Price cannot be predicted. Price is whatever it is between a buyer and a seller at a particular moment. But there are certain times when price exhibits non-random behavior. And that behavior, or that non-random behavior, takes place when the market is trending. During trends, uptrends and downtrends, especially well-defined movements, you have traders exhibiting non-random behavior that you can apply some experience, some knowledge, and some strategy to. So the goal here is to determine the direction of the markets, not when to enter and exit a trade. Of course, this is not to say that there was no trading opportunity in the shorter term time frames, such as the daily or the hourly charts. But to those traders who want to trade with the trend rather than trading the correction, one could wait for the trend to resume and trade again in the direction of the trend. So a trending market, and let's not mix up trending market with a trend line. A trending market is one in which price is generally moving in one direction. Sure, price may go against a trend every now and then, but look at the longer term time frames would help show you that those were just retracements. When buyers, or conversely sellers, are pushing price, it takes a lot of momentum. It takes a lot of energy. But once they get that stone rolling, it will continue to roll and roll and roll until it hits some type of a stop, some reason to stop. So when a market is trending up, it will tend to continue that. When a market is trending down, it will continue tend to continue that direction until something stops it. Something has to stop that momentum or the energy. Now, trends are usually noted by higher highs and higher lows. In an uptrend, or lower lows and lower highs and lower lows in a downtrend. When trading a trend-based strategy, traders usually pick the major currencies as well as other currencies utilizing the dollar because these pairs tend to trend and are more liquid than other pairs. But you can trade whatever you like. Now, the more well-defined the trend is, the more high probability trade you will take out of it. Now, you can also apply other technical tools to help you learn or see if price is trending or not. So remember, we have three types of trends. We have an uptrend, we have a downtrend, and we have a sideways trend. Most of the time, the market spend is in sideways or undeveloped trends or congestion, because an uptrend, a well-developed uptrend, is making higher highs, then easing to higher low, then moving back up, peaks and mountains, troughs and valleys that are well-defined. The more well-defined this is, the better our trade scenario can be. So, along with these three trend directions, there are three trend classifications that have to do with time duration in which the trend is taking place. So you have uptrend, downtrend, and sideways. And then we have short-term, long-term, and medium-term or intermediate trends. Now, the short-term trends are components of both major and intermediate trends. So as you can see on the chart, you can have a medium-term trend and a short-term trend within a long-term trend. Now, one of the best ways that we can see these trends is maybe using moving averages, because moving averages will help us see the direction markets. A moving average takes the noise out of the markets. There's lots of indicators that also tell us whether price is moving up or down. Let's pop over to a live chart and let's take a look at some easy to spot trends. Okay, here's the Euro US dollar. This is the current Euro US dollar chart, my standard teaching chart. Now we can look at that and we can see a well-defined price movement. Push, ease, push, ease, push, ease. Now we see the prices moving into sideways congestion. Now we're waiting for it to exhibit where it is going to go at this price. But if we go back and look at this from a longer perspective, what do we see that's different? That price really isn't in that beautifully defined downtrend. Price is just coming off of a short-term or an intermediary uptrend. So this is possibly just a retracement of that. But we can also see that price came off of this very well-defined downtrend from the 114 all the way down to the 106. Then it moved back up to the 107 or the 111 price, and now it's fallen back down to the 110 price. Okay. And when we see a trend, we can predict, especially with currencies tend to retrace up to 100% of their prior price move. So we're now making an understanding or an explanation of what price is doing. We have a better understanding. So if we go back a little bit farther, what do we see now? We see something completely different. And if we go back to a longer term chart, now we can see the price since January of 18 has been trending down. So we know overall there's been pressure on the euro, it's been falling. Okay. We know that the euro hit the bottom and then started to retrace back upwards and was making an uptrend. Right now in today's market, in a short-term market, we are seeing a well-defined downtrend. So we have three valuable pieces of information. We have an environmental piece of information. So we know the pressure on the euro. It's like saying, you know, this beautiful girl over there or this tall, handsome guy over there that are built great have put on 5 kilos. You can't look at it and see it. But when they tell you they're on a diet and you say, well, wow, you're built great, you're trying to amaze why. But if you would have realized what, or if you would have seen what they were a month ago and see where they are now and understand why they're on a diet because they add, it starts to put things in perspective. And this is important for us to know in the marketplace because it allows us to start putting rules and regulations and defining our trade. So here we're looking at the pound Canadian dollar. Look at that. We have a very nice defined uptrend in a 2-hour chart. In a 1-hour chart, we see it even better. We see the price has been steadily pushing up, making peaks and ahs, pushes and eases, peaks and valleys moving up and down. Okay. Now, again, if we were to go back and look at this in a 1-day chart, we would see something completely different. That price fell way down, then price recovered and almost recovered to 100%, and now price is moving in a sideways congested mess. So understanding price movement and the trend helps us put things in perspective. Now we have things like Bollinger Bands, which will help us see a trending market. It's a great indicator. Bollinger Bands make it easy to confirm a trend visually. Downtrend can be confirmed when price is in the sell zone, and uptrends can be confirmed when price is in the buy zone. Now, trends tend to move in waves. Okay. By setting up short-term exponential moving averages and long-term simple moving averages on a weekly and daily chart, it's possible to gauge the direction of the trend. Knowing the trend does not help in taking a position, but bear in mind that these markets move in waves. These waves can be called impulse waves when the direction of the trend, or the corrective wave when it's contrary to a trend. These are the pushes and eases or peaks and valleys. By counting the waves or pivots of each wave, one can attempt to anticipate whether a trading opportunity will be against the trend or with the trend. According to Elliott wave theory, an impulse wave usually consists of 5 swings and a corrective wave, usually consisting of 3 swings. So in other words, push, ease, push, ease, push, ease, push, ease, push, ease, 5 waves, and then ease, slight push, ease, slight, and then reversing and moving up. Okay. Now, I don't particularly follow waves and pivots, and I'm not sure I believe in these cycles. Okay. But lots of traders do, so I'm not advising you against them. So in this image gives us an example of the Elliott wave, because Elliott wave theory can be very subjective. I prefer to use a pivot count to help me determine wave exhaustion. This usually translates into a minimum of 7 pivots when going with a trend. Now also Fibonacci retracements will help us see when price is retracing and where it's supposed to be correcting. But sometimes the markets will not cooperate with these technical assumptions, but it can occur often enough to provide some very lucrative trading opportunities. The bottom line is combining the moving average diagnosis with pivot count and then fine-tuning the analysis with an observation of candle patterns. A trader can stack the odds of making successful trades in his or her favor. Remember, trading is a craft, which means that it is both art and science and requires practice to develop consistency. One of the easiest and most reliable ways to make money trading Forex is to follow trends and let winning trades run for as long as they will run. When you trade like this, most of your losing trades will be small move losing trades, but often or sooner or later you have some large winners. And the whole idea is that you have maybe 7 losers and 3 winners, but those winners, those profitable trades far exceed your losing trades, so you end up with a net profit because you're not going to trade at 50% right all the time. You're not going to trade at 40% wrong all the time. It's very rare. It's to minimize your risk at all times. Great stop losses and trends will help you determine where to put your stop loss. It'll help you get out of the market at the right point. So what you need, of course, is at least one trend to exploit. When the Forex market is very flat and trends are completely absent, trend traders cannot avoid losing money if they want to participate. So identifying trends becomes really vital. And sitting back and waiting, too many traders just want to trade. I only trade markets that are in well-developed trends. Okay, there's usually enough of them, but if there isn't anything, then I sit tight. So the identification of patterns and trends are techniques used by analysts studying the supply and demand of an asset traded on an open market. A trend is the general direction of price over a period of time. A pattern is a set of data that follows a recognizable form, which analysts then attempt to find in the current data. Analysts use trend lines and channels, triangles and flags and pennants, okay, double tops, triple tops, in an attempt to spot and define trends. Upward trends are characterized by an asset hitting a series of higher highs and higher lows, while a downtrend is just the opposite. But then what we want to do is we want to attach what's called a trend line. Now trend lines are rule-based. Trend lines put a line across the charts. Trend lines represent a charting technique which a line is added to represent the trend in the currency pair. Drawing a trend line is as simple as drawing a straight line that follows the general trend. Trend lines can be used to identify trends. Trend lines help you see that you're making higher highs and higher lows. By drawing your trend line from the swing low of the current trend and up to the current price, and no price can break through it, means that everything is supported higher highs and higher lows, higher highs, the stepping of up of the flight of stairs. Okay. If you see that trend line is constantly getting violated, that's telling you that trend is not so well defined. So thank you very much for joining us, and join us in our class on drawing trend lines. But this gives you some food for thought. And remember, trend lines are a technical analysis tool, and trend lines are a tool used to project major trends. During an uptrend, we see the progress of higher swing highs and higher swing lows. During a downtrend, we see just the opposite. So understanding the basic concepts of price action is crucial because it applies to every trend we trade. If trading with a trend, we want to see this type of movement, higher highs and higher lows. Now, price charts produce noise. Noise is the small random movements that can make it hard to spot the trend. Therefore, many traders prefer to simplify their charts. So you would draw a trend line which will give you a clear, concise view of how that trend is acting. And a violation of that trend line tells you that trend is facing some problems. Either it's losing its momentum, it's about to end, or the buyers or the sellers, depending whether they are having a problem pushing it forward. Trend lines are not only based on price, but also have a time element. This creates a great myth. Traders will often say that because the trend is broken, the trend is over. It isn't. When the trend is broken, you redraw that trend, and price might continue at a slower speed in the direction it was moving. So there are 3 very important keys to drawing effective trend lines. The higher time frames We'll always produce the most reliable trend lines. Most trend lines you come across will have some overlap from the high to the low of a candle. But what's important is getting the most touches possible without cutting through the body of a candle. Never try to force a trend line to fit. If it doesn't fit the chart, then it isn't valid, it isn't therefore having on your chart, period, the end. So the goal of every trader is to buy low and sell high within a currency price trend. Trend lines give us a way to identify the high and low ranges of the trend. As an example, if we are looking to buy a currency pair based on our fundamental view and is pulling back to the uptrend line, this gives us an area to buy the currency at a low price in the current trend. The exact same is true in a downtrend. So think about understanding, and this is the first part of reading charts. I have a trend line in every chart, and that's followed by support and resistance regardless of what strategy I'm using. My trend lines are always current because they keep me quickly abreast and attuned to what price is doing. So again, thank you very much for joining us, and we'll talk to you again real soon. Remember, please subscribe.